Okay, welcome to the Module 2 Sector Spotlight. We're going to look at precious metals. This module, now from this module onwards, I'm going to talk to you about correlations. So kind of an important definition for this module, correlation. Now, I'm sure you all know what correlation means. If two things are correlated, they tend to do the same thing, right? And that's exactly what we're talking about here. So correlation is a measure of the similarity in movement between two stocks over time. So if we look at two different stocks, do they tend to move up together? Do they tend to, if one moves up, the other moves down? Is there no relationship? That's what we're going to look at. This is key to building up your overall investment portfolio. A correlation, when you actually quantify it, it's going to range between a 0, 1, and 1. Okay, minimum 0, 1, maximum of 1. If it's a negative number, that means the two items tend to have an inverse correlation with each other. And if it's positive, they have a positive correlation with each other. And the closer the number is to 1, the more correlated they are. So if we have two stocks and their correlation is 1, that means if one stock moves up, the other moves up. If we have two stocks and their correlation is -1, that means as one stock moves up, the other moves down. And then if we have two stocks where their correlation is, say, a 0.1 or a -0.1, there isn't much correlation at all. They just tend to do their own thing. Okay. Now, this does not quantify the magnitude of the move. It doesn't mean that if stock A moves up $10 and there's a correlation of 1, stock B will move up $10. It just means they'll both move up. We'll look at quantifying that a little bit later in the course. That's called the beta of two investments. That's where you actually quantify the amount they move in addition to the correlation. Now, we're going to pretty much always correlate to SPY. And the reason that we do that is SPY is one of the most liquid ETFs or stocks. ETF stock, you can call it either, really. Liquid meaning it trades a lot, literally millions of shares and option contracts a day. That means it gives us a pretty solid baseline. It's a kind of a pure instrument. It doesn't bounce around. There aren't a lot of investor calls that affect it. It just kind of does its thing. So we tend to correlate to SPY. So no matter which stock we're looking at, we'll correlate it to SPY, and then it'll give us a feel for how that stock moves. And then we're going to be looking at a 90-day correlation. Okay, you can adjust all these things as you move along, though. All right, so that's correlation. With that in mind, let's take a look at our equity indexes. We talked about these in Module 1. So this is SPY, QQQ, DIA, and IWM. They tend to be very highly correlated, okay? So the correlation of QQQ to SPY, 0.84, DIA, 0.98, IWM, 0.94. Now this is the recording of this video. These are more or less 1. They pretty much move in the same way. Now, not to get too bogged down with financial advisors, but if you look at, if any of you have investments, and I'll use some of these, you gave me some examples already. The first thing you want to look at is correlation, because a financial advisor will tell you you want to be diversified. Now, one of the ways that they'll make you diversified is by buying into one of these indexes. That is true, technically a good way to diversify. If you think about SPY, it has 500 stocks in it. So you're diversifying across these 500 companies rather than buying one stock in one company. That is true. But if they buy you into the S&P 500, the Dow, the NASDAQ, and the Russell, and they say that that is diversification, that's a bunch of crap because they all move in about the same way. So check that out. I'll put some examples up in the notes here of the correlations for some of the ones that you've shared with me already. Okay. So that's what we looked at last week. Now let's look at precious metals. Let's start with gold. These are some underlying symbols you can trade for gold: GLD, GDX, and GDXJ. GLD is gold. I mean, it's literal gold. This is an ETF, exchange traded fund, which essentially contains futures gold contracts. GDX and GDXJ are indexes of companies that are affected by the price of gold. they're essentially gold miners. Like these are companies that mine for gold or build the equipment that mine for gold, those types of things. GDX is the gold miners and GDXJ is Gold Miner Junior. Let's look at the correlations. So GLD, it says 0.072. That doesn't seem right. So let me go to Thinkorswim and we'll look at how we can do this. In the watch list over on the right, if you've added correlation, scroll all the way down to the bottom. Actually, let's create ourselves a new watch list. So go up here to where you've got that S&P 500. And down here, just go to create watch list. Just give it a name. I'm just going to call it Mark's watch list. And click save. Okay, and that'll clear it out. And here in the symbol, just type GLD. And let's see what we get for the correlation. It'll take a second to calculate. 0.73. Yeah, it's just I did the wrong decimal point. So 0.73, and it's negative. So you can see that that's not a bad correlation. What that essentially is saying is that when the SP 500 goes up, most of the time GLD goes down. Okay, not a, it's not 1, but it's getting there. GDX, pretty much no correlation, but it is slightly negative. GDX day, again, not much of a correlation. Now, what does that mean? That means that you can invest money in GDX and GDXJ, and if the market, if the SP 500 is doing something, it's going up, it's going down, it doesn't matter. So you can have multiple investments. Some make money one day and some make money another day. And this is the whole thing about active trading too, is we're going to have some investments that are losing some of the time and some that are making. As we make money on one investment, we close it out. And then the next day, the one that was losing is going to start making money. So we're always making money on all these different movements. And that's why correlation is important. It's also good for hedging. What this means is that, based on this correlation, it's not super high, but you know that GLD is probably going to go up when the SP goes down. So if you have positions in both SPY and GLD, what that means is that, oh my God, there's a day where the market goes down. Well, that's okay because you've got positions in gold, and gold's going to go up. So you're going to make money on the day when the market goes down. Okay, so keep these in mind: GLD, GDX, and GDXJ. Put them in your watch list. So let's go back to Thinkorswim. And again, I did that watch list. I just hit the watch list name and I went to create. So we'll do GLD, GDX, and GDXJ. Okay. And there we've got the correlations. And again, if you've got your items linked here, we can go look at the charts. And the other thing to be aware of is just the price. GLD is quite expensive. It's $117 a share. But GDX and GDXJ are much less. Look at GDX is only $25 a share. It's pretty decent. You could definitely sell some puts in there. If we went to, let's look at it. It's kind of high right now. So let's just say we were going to sell a call. So go to trade tab. It's pretty high. We're going to sell a call. We're going to be a contrarian. We're going to see if it's going to go down. So I'm going to go to the trade tab for GDX, and let's see what we got here. 33 days. Let's take a look at the 47 days. Yeah, this will work. And 30 delta, that's 60 cents. That's not too bad. So I can sell that. Let's look at my buying power for that. So I go confirm and send. Look at my buying power effect, $300. That's pretty decent. Okay. If it were going down, I could sell the 30 delta put. What's the buying power on that? Yeah, about $400. Now, we'll come back to this much more as we go on, but you try to make your buying power of each trade about 5% of your portfolio size. So how would that work out? Where's my calculator at? Come here, calculator. Whoa. Calculator. There we go. So it was $400, right? Yeah, so if you had about an $8,000 portfolio, you could pretty safely sell a put in GDXJ. So it's pretty good, in GDX, excuse me. My favorite is actually GDXJ. And I don't know if you can see here or not. You might be able to guess why it's my favorite. Look at the implied volatilities. GLD is 15, GDX is 38, GDXJ is 48. Now I know we've not gone into real detail on what implied volatility is, but essentially the higher the better. You're going to make more money on higher implied volatility stocks than you are on lower. That's why GDXJ is one of my favorite. In fact, I almost always have positions on GDXJ. Let's take a look in my positions here. Yep, I have one right there. GDXJ. I have a call spread on in GDXJ. And, oh, it's made $2. How exciting. All right, so that's gold. Gold. Next, silver, SLV. So let's put that in our watch list. So go Thinkorswim, click in that little box, SLV, enter. What do we got here? 25% implied volatility, negative 0.5 correlation. Let's take a look at the chart. SLV. Yeah, so it's not particularly correlated with SPY, which is good. Again, you want non-correlated stocks. But let's look at all the charts. So his GLD. The GLD went down, then went up a little bit. GDX down. Red is down, green is up, right? Down, then up a little bit. GDXJ down, then up a little bit. SLV down, then up a little bit more, right? But do you think that the gold and silver are correlated to each other? We could actually quantify that by adjusting our correlation, but you can see just by eyeballing it, they're about the same. Let me show you how you would do that. In your watch list, hit the little cogwheel, go to customize. Under this correlation here, just change this from SPY to GLD, and this will change that correlation to 90 days for GLD. Give it a second to update. It may take a second here to update. Did I do that right? Yeah, I didn't do that right. Hang on. Delete that out. I want to change that to GLD if my computer will cooperate with me, which it's not doing. Oops. Oh well. Let's try it one more time. Delete GLD. GLD. Okay, did we get it this time? Yes, there we go. And let's give it a second. There we go, perfect. So GLD, obviously, it's correlated to itself, right? 1.0. GDX, 0.82, 0.88 for GDXJ, and 0.91 for SLV. So over the last 90 days, all of these have kind of moved together. And that makes sense, right? You would expect the items in the same sector to move together. Correlation is very important. So if you put on trades in all four of these underlines, these stocks, and let's say you sold a put in all of them, you're more or less doing the same trade because they're correlated to each other. But if I were to sell a put in GLD and then also sell a put in SPY, I have two uncorrelated, two negatively correlated trades. One's going to make money one day, one's going to lose money, and then the inverse is going to be true the next day. That's great for active investors because we're not looking to be in the long term. We're looking to be in for about 45 days. Preferably, we'd like to be about 22 days. I'll talk about that a little bit later module. But being uncorrelated allows us to do that. Okay, very cool. So those are the precious metals. There are others. There's platinum, copper. Unfortunately, they don't have a lot of particularly liquid ETFs. If you're a high roller, if you've got like a 500,000 or $1 million in your account, you can trade platinum, copper on the futures market. So /PL is platinum. And you'll find its correlations are similar. But if you've got some big bucks to spend, platinum, copper, I think aluminum is on that too, or aluminium as they say where I come from. But GLD, GDX, GDXJ, and SLV should give you plenty of ammunition for doing trades. So that's our market sector for this module. Enjoy.